able to take advantage of certain opportunities that may come up. What kind of opportunities are we talking about?
So look, there's various opportunities that are readily available. One of them that you stated was the bonds market. Look, the bonds market is definitely something more beneficial right now than generally going into cash because of the interest rate lowering. You're definitely not going to get the most beneficial interest rate when you're putting your money into cash other than just putting it into bonds, right? The other one then is actually the value investing theory or style of investing, which generally means that because of the recession and what's happening right now with the markets plummeting right now, right? A lot of the shares are going below book value, below intrinsic value, which means that if you do the analysis of the fund value or the shares that you want to buy at this point in time, they're probably selling below par. And it would be very beneficial for you to buy them right now, because even though they're selling below par, and making sure that their finances and the company is not having a Steinhoff situation or whatever the case might be, generally if they're selling below what their book value is, it is going to go to equilibrium, which is generally where it's supposed to be with the book value. So it will be at equilibrium, right?
And that's where you make your money. So
and that's when you're going to make your money.
In layman's terms, what you are essentially saying is, and I think Warren Buffett speaks a little bit about this. He says you're not buying the shares, you're buying the company. So if you are finding yourself in a situation where the intrinsic value, the real value of the share, the book value of the share is below what it would have been normally sold at normal market conditions, then that's something to look into buying, because when it reaches that equilibrium, the real value of it, right?
So when the share value reaches the actual book value, right, of how much it actually it's valued at. If the share value is at the book value, that's where you're going to get your returns, right? And even if the share value goes higher, good for you. You are going to get more returns in that regard because you bought it at a lesser price.
So let's make an example. You buy right now avocados. I mean, avocados are scarce right now, right? So because they're scarce, okay, sure. But if they were to become a huge supply of avocados, and avocados drop to a price of 10 Rand an avocado at Woolworths now, we're talking about avocados at Woolworths. Woolworths is selling their avocado at 10 Rand, and you buy a stack amount of avocados at Woolworths at 10 Rand. When the market corrects itself and the prices of avocados goes to the real price, and the real price, let's say, is 20 Rand an avocado, you are making that margin of 10 Rand, basically.
Spot on.
And if something is to happen that the price goes even higher, you are even making that
because of the scarcity. Because of the scarcity of avocados. So let's say, for instance, it goes back to where it was, but now there becomes a scarcity with avocados where they're not readily available, which means that it's no longer 20 Rand, it becomes 30 Rand. That means you're getting even more money.
That's actually so that's called value?
That's value investing.
Value investing. That's actually very, very interesting because
it is. I think I need to also bear in mind that when I speak about these things, I do feel like you need to speak to a professional such as financial planners or investment people, because when I say that, there's a lot of research that goes into these companies that you're probably not going to see with the naked eye, right?
And that's what I was going to ask. That's what I was going to ask. I was going to ask, how does the average person then know what is the actual, for instance, if you take a Capitec share, at some point we all knew the Capitec share price was not the real value. Let's just have an honest conversation, right? But how does an average person like me, who does not know these things, probably doesn't even know how to read a financial report of a company, how would I know what the intrinsic value of a share actually is?
So, and here's I'm saying that you shouldn't even go into that, because now we're going to speak about price to earnings ratios. We're going to start speaking about very technical things that we don't want to go into. what you need to do, especially for people that are novice investors, people that are not used to it, they don't even know how the financial industry works. Start your way by going into funds such as unit trusts, ETFs. Go into those type of funds. And the reason why you do that is because there's going to be fund managers that do the hard labor for you, right?
Yeah.
And when you look at the fact sheet, when you look at the fund fact sheet of the fund that you want to go into, it gives you so much information. It tells you the investment style. It tells you what their mandate is, how they're investing, what type of companies they're investing in, what type of equities they're investing in. And most probably in those investment funds, they're going to tell you, are they a value investor? Are they a growth investor? Are they a multi-asset investor? They tell you so much information in terms of the fund so that you know that, hang on, okay, we are in a recession. I should probably go into value investing. Maybe I should start looking at these funds. But obviously, if you don't know that information, it would be important for you to see a financial planner or a financial advisor. Because as much as we're saying value investing, there's also the diversification thereof. Because we can't only look at value investing, we also need to make sure we diversify it so that the risk is not only burdened on the value investing or the equity that you chose at that point in time, but also make sure that the cash can carry you out, the bonds can carry you out, as well as the property can carry you out at that point in time.
Yo, I can't even begin to stress the importance of diversification, and I think you've literally put it in probably the layman's terms as possible. And I think, Thandekile, the biggest problem you see is that with the trend of saying people are now more interested in investing, we then have companies like Easy Equities that have said, and I know we've had this conversation, that have made investing a little bit easier and accessible to people. But the problem again comes back to, what do I actually invest in if I do not, from a novice perspective, don't even understand how to begin reading a fund fact sheet? I mean, a simple thing like a fund fact sheet. And the only fund fact sheet for individual shares are the financial reports, you know? So I've got to read this financial reports. So how do we rebalance that? Because the other thing you must also understand, Thandekile, to be quite honest, is that a lot of people would not know where to start to look for somebody that can help them with shares and equity market investing, right? Because when you do go to financial advisors, they'll tell you, I don't do that, right? And then you are now left to go to the brokers. And when you look at the fees of the brokers, and also just the job of having to talk to a broker about investing in shares, when Easy Equities has told you can do it yourself, there's a disconnect, you know? So how do we fix that?
I always say this when I speak about Easy Equities, I kid you not. I need to find out who their marketing team is.
The lady that I knew had left. The lady I knew.
I kid you not. They've got the most brilliant marketing team ever. But you know what? Easy Equities is basically, what they did is capitalize on the UX, which is the user experience of the client, which means that they saw the bottlenecks in terms of people or the public looking to invest, right? And they saw that, hang on, people are not investing because, firstly, it's not really readily accessible. And then these finance people come and they speak all these jargons and we're not ready to hear these things. And then after that, they're going to ask for these huge lump sums or contributions that we don't have to invest. And then Easy Equity says, you know what, we're going to break down all of this and we're going to make this readily accessible. I extremely commend them for that. However, that being said, it's the big bad. The problem now is that there's going to be a huge influx of people that are going to start investing. And
there is already, Thandekile, there is already.
People are doing a ching chong cha on what shares to buy, on what ETFs to buy, on it's basically it's guesswork. It's guesswork, and I do not blame them. I'm referring to the public in terms of the decisions that they make, because obviously they don't know better. Here's the opportunity for me to actually make, or to actually take the strive and the move to actually start investing. And Easy Equities is giving us the opportunity, but I don't know the long-term consequences of what I'm doing. And that's what I'm worried about, because as much as we feel like we're investing now and that we're doing a good deed now, in the long term, subsequently, it's not going to be coherent, or it's not going to be beneficial to what you're trying to achieve in the long term. And that's when, and my biggest fear is that now it seems fine, but in 5 years, 10 years, 15 years from now, you're going to say, hang on, I may have made a mistake. I should have done things a little bit different.
And that
And
might be
that's
too late.
why, yes, and that's why right now, that's why RDR is so important, and the shift of financial planners, right, or financial advisors, from product-based and commission-based, right, to actually looking at the holistic picture, because there's going to be the Easy Equities, there's going to be a lot of other brokerages that are going to come our way. And the financial planner should be able to merge everything together and actually look at the Easy Equity account that you have and tell you that this and this and this is wrong. This is not going to work for you. Maybe we should do this. Or actually, this is going to work for you, but it's going to go into a different goal. Do you understand what I mean? Now we're able to maneuver around what you currently have.
But then, Thandekile, and this is where the problem is, right? And often people think that the financial services sector is out to get them, you know. So for an ordinary person, and I fully understand what you are saying, and I think everybody that's watching understands what you're saying, and I think Trudy kind of contextualizes as well. She says you can't self-medicate the symptoms or go to a professional and get the correct prescription to diagnose and cure the root cause. Easy Equities is self-medication. But the problem is that it almost feels like the doctors are being elitist about how to actually diagnose and help people. Is there a potential partnership then for instance, SimWap coming in and saying to Easy Equities, we see where you guys are going, we like what you guys are doing, but however, can we support you in terms of making the user experience even more easier in terms of proper strategies that people can follow? Because as you rightfully say, right now, all of us, we're all in Pick and Pay, and we're just taking from the shelves. We're taking from the shelves. And my biggest fear, and you pointed it out, is that after 15 years, people are going to be discouraged even more, because they're going to look at their portfolios might not have done well, and essentially what's going to happen is that people are going to pull out of the investment world again and say this thing doesn't work.
Yeah. I mean that's spot on. I think you said it spot on, you know, the relationships, especially because the new kids on the blocks and on the block, and I'd like to say that Easy Equity, especially in the financial product element, because they've able to create the brokerage element into a product. Because they are the new kids on the block, we definitely need to merge the new synergies going in that direction. Because as I said, is that we need to be able to collaborate, such as you said as well, so that everything can merge together and people understand the benefits of each factor together. Because trust you me, the fact that someone can buy a portion of shares, and not all shares, for as little as 10 Rand, or how much, whatever it is, 100 Rand, or whatever the case might be, the fact that that is readily available means that people no longer have the opportunity to say that I do not have money. Do you understand what I mean?
Yes.
There's the opportunity to invest with whatever little that you have. There is an opportunity. However, we need to make sure that this opportunity is going to be something that is going to be beneficial for the long term of the public.
Yeah. So basically what you're saying is that it can't be a tick box exercise. It can't be, but I've invested and I've got shares. But now, here's the difficult thing, especially with the equity market, is that we know that the equity market at some point in the long run will show benefit, right? And perhaps maybe that's where we are. And I think maybe to just, I mean, we'll take a couple of questions before we end it off. My biggest fear right now is that a lot of what the traditional financial planning is what's the word, is offering or putting on the table, especially for young people, is the ideal way of doing financial planning. It is a monthly contribution to a certain plan. And we know with unemployment in South Africa, with income restrictions in this country, to be able to contribute monthly is not everybody's norm and not everybody's ideal. How do we make sure that there is available plans that don't seek to push people into a box and make predictions about who they are and how they get their income?
I think we need to go back to the conversation we had firstly on one, how do you choose your financial planner?
Yeah.
It's of paramount importance. One, how do you choose your financial planner? Because when you choose your financial planner, you get the feel of, does this person actually understand my background, my demographic, my socioeconomic problems, what I am facing? What is the general life cycle of my life? What do I experience as a person? And what that does is that it doesn't confine people into boxes of these are the products that you need to take on. So I kid you not, the financial planner that you take on is of paramount importance, because it's like any other relationship, any other relationship. You need to suss out who you're having this relationship with. You can't go into, I don't want to say bed, but I'm going to say, you can't go into bed with someone. You can't go into bed with someone that you don't understand, that you haven't sussed out, that you don't understand that they have your best intentions at heart. You need to understand that this person understands ukuthi ekhaya umama uhlala in a three room. I need to ukuthi ngisi imali ekhaya. Do you understand what I mean?
I need where I might not be able to contribute.
Yes, I can't put in money every single month. How am I going to come up with a strategy that is going to be beneficial for me? Or as in net bonus izayo. Help me plan around this bonus. Not only with invest when my fees, but maybe with in season flexibility cash flow. So it helps me with my cash flow, so that maybe if I pay off the school fees of the children, right? Because there's that early bird thing that they do at the beginning of the year. If I pay with my bonus that early thing, maybe early bird, maybe I can start the monthly contributions because of freed up money. We need to start strategizing in regards to what our clients need. And that's why it's important to choose who your financial planner is. Unfortunately, there's not a lot of financial planners that are within a certain demographic. And what that does is that you are going to be sold products because people don't understand what you need. I can't, I don't want to be prejudiced. I don't want to be prejudiced or anything of that nature, but whoever knows. But what I'm trying to say is that you need to have someone that actually has your best interest at heart and actually has the qualifications, the expertise, and understands what you're trying to achieve, and someone you can have a proper conversation with. I've had so many conversations with friends, with family that told me that, I went to a financial advisor's office and I left. And the reason why I left is because this person was speaking over me. This person was not speaking to me, was not hearing me, was not hearing my needs. And in most instances, the people that they were speaking to were not of their demographic. And we need to change that, because if you are of the same demographic, we know our needs. I can't tell.
Because sometimes also it's hard for me as Nicolette to be able to voice out my needs. And it will be much more easier if the other person on the other side looks like me, because even if they're playing a guessing game, they can relate to what I'm talking about, so I think that for me is really what's important. And I mean, I've often had this conversation with a lot of financial planners to say, get to know me as a person and let me get to know you as a person before the suit and the tie. Because at the end of the day, the suit and the tie are just covers. But I need to know what's in your heart for me to be able to start opening myself up and saying, yes, because I can't tell a person who doesn't look like me, doesn't sound like me, doesn't know me, because I'm also trying to put on a front. So if you say to me, will you be able to contribute 2,000 Rand every month to a life insurance? I'm just like, yes. Yes, I will. But the reality is I
Yes.
can't, you know?
And purely for me, as a financial planner, okay, firstly, it's solely dependent on what your tax bracket is. But just generally, in terms of the demographic of a Black person, I can't expect you to be paying a premium of 2,000 for risk if you don't have any investments, if you don't have. Come on.
Oh,
Like,
Thandekile,
come on. Like,
listen,
come on.
I want to cut it here because I want to do this with you
Sure.
again, and
Sure.
I think you have really just blown open a whole door of conversation that I think is very important for us to put into a video. We gotta go onto YouTube. We've got to put this out there.
Sure.
I'm gonna try and see how best I can download this video because I think it needs to go on YouTube. I want to put it everywhere where people can access it. But you've been absolutely fantastic, and I am so excited and happy to have you as part of the Financial Bunny Gym. I could not
Yeah,
have
I'm
gone into
excited.
bed with a better person. And you speak about finding the right type of partners and relationships